Could a so-called boring business, like just changing oil, actually be a surprisingly smart investment? Well, today we're diving deep into the engine room of the economy to break down the financials of quick loop franchises. We're going to find out if this is an overlooked road to riches.
I mean, think about it. What makes a business truly resilient? It usually comes down to essential, non-discretionary demand. Things people have to do, not just what they want to do. And let's be honest, for most car owners, routine maintenance isn't a luxury. It's an absolute necessity.
And yeah, that necessity, it really adds up. By 2034, the oil change market here in the US is projected to be worth almost $15 billion. This is not some little niche industry, it's a massive economic engine, and it runs on predictable, recurring demand. So, could this be the right investment for you? To figure that out, we're going on a little investor's journey. We'll uncover the hidden appeal of this model, explore the two main paths to making money, dissect the real numbers, face the roadblocks, tackle the big electric elephant in the room, and then we'll deliver our final verdict.
Okay, first up, the unexpected allure. Beyond just pouring oil into an engine, what makes this simple business model so darn powerful?
Well, the foundation of this business is just rock solid. With almost 300 million vehicles on the road in the US needing oil changes, the customer base is huge and predictable. The model itself, it's simple, it's repeatable, which is perfect for franchising. And that simplicity helps build customer loyalty, bringing folks back every few thousand miles. But the real secret sauce, that's in the upsell, turning a standard oil change into a much higher margin sale with things like new air filters or wiper blades.
And that whole business model translates directly to the bottom line. We are not talking about razor-thin margins here. A well-run shop can see net profits somewhere between 15% and an incredible 40%. Now that is the kind of cash flow that makes serious investors sit up and pay attention. So, how do operators actually hit those margins? Well, it turns out there are two main strategies that are really shaping the industry today. On one side, you've got the express stay-in-your-car model, think Take 5, which is all about speed and volume. Get 'em in, get 'em out. On the other side, there's the full-service model, like a traditional Jiffy Lube, which takes a little longer but really aims for a bigger ticket size. The difference is pretty stark when you look at the margins. The Superfast Express model often pulls in a much higher EBITDA margin, which is basically a measure of its core profitability, than its full-service cousin. All right, let's pop the hood and really look at the unit economics. How does a single oil change actually turn into real profit? Well, the top-line numbers are seriously impressive. Just look at the average unit volume, or AUV, for the big franchise brands. That's the average yearly revenue per store. Valvoline is leading the pack at over $1.5 million. It just goes to show you the massive cash flow potential when you have a strong brand and a service that everybody needs. But where does all that revenue go? Okay, in a typical setup, labor and the cost of goods sold, so your oil and filters, eat up the two biggest slices of the pie. Then after royalties and overhead, what's left over is your profit, which in this example is a very healthy 15%. So the key to making that profit slice bigger is simple. You have to control your labor and material costs. And here it is, the magic number for a healthy, scalable business, a gross profit margin of at least 70%. What that means is, before you even think about paying your staff or the rent, for every single dollar that comes in the door, you need 70 cents left after paying for the oil and the filter. That's the money you use to run the business and, ultimately, to take home as profit.
Of course, it is not all smooth sailing. The road to profitability is definitely filled with some pretty big roadblocks that any potential owner needs to be ready for.
First off, the price tag to get in the game can be pretty steep. The total investment can be anywhere from a couple $100,000 to nearly $2 million. The market is also incredibly competitive. You've got everyone from dealerships to big box stores offering oil changes. And finding and keeping good, reliable technicians, that's a constant battle. And finally, you're dealing with hazardous materials, which means strict environmental rules and a lot of liability if anything goes wrong.
Yeah, let's just zero in on that workforce challenge for a second. Labor is a huge variable cost, and how you manage it really depends on your business model. An ultra-efficient express shop like Strickland Brothers might keep labor costs down to just 15% of revenue. But a more complex, full-service operation like Valvoline, that number nearly doubles, and that difference flows directly to your bottom line.
Okay, now for the biggest question of all, the one that kind of looms over this entire industry, the electric elephant in the room. What happens when your main service is no longer needed?
It's the existential threat, right? Battery electric vehicles don't have internal combustion engines, so they don't need oil changes.
So is this just the end of the road for the quick lube business?
Not so fast. While the future is definitely electric, the transition is going to take decades. Because the average car on the road is over 12 years old, analysts figure that even in 2030, a whopping 85% of vehicles in the US will still need regular oil changes. That gives the industry a very, very long runway to adapt.
And that adaptation, it's already happening. The forward-thinking franchises are already making the pivot. I mean, EVs are heavy, they wear out tires faster, their batteries have complex cooling systems that need service, they still have brakes and suspension that wear out, and every single car, whether it's electric or gas, needs its cabin air filters changed. The future is all about becoming a one-stop shop for all that light-duty maintenance. So after weighing the powerful economics against the big challenges and that electric future, what's the final verdict? Who should seriously be looking at this kind of investment?
Here's the deal. This is not a passive investment. The ideal owner has access to some serious capital to get started. They have to understand that in a super crowded market, amazing customer service is the ultimate tiebreaker. And most importantly, they have to be ready to be hands-on, managing the day-to-day realities of running an auto service business, from staffing to inventory to compliance.
And that really brings us to our final thought. As this industry evolves, maybe the most valuable thing it sells isn't actually oil, but time. By offering fast, convenient, essential maintenance, these shops are really selling a solution to our increasingly busy lives. The big question is, can they continue to own that 10-minute promise for the next generation of cars?